I want to turn to another issue of great public concern, the meltdown in the rupee. That's right, the rupee has breached the 90 rupee mark for the first time vis-a-vis the dollar. The Indian currency touched a low of 90.29 mid on persistent dollar demand from importers and foreign portfolio investors. The fall was also accelerated by the absence of dollar sales by the Reserve Bank of India. The 90 level was crossed moments into trade. This morning it caused some panic. Dealers say the next support level cannot be as estimated with the dollar rupee surge at this pace. The rupee has fallen 5% this year, one of the worst performing currencies in the continent of Asia at the moment. Big questions. What explains the rupee slide? Trump's tariffs impacting the rupee? Time for RBI to step in. And let me add another question. Is it good or a bad thing? Two very formidable guests joining me. Sajjid Chinoy, Managing Director, Chief India Economist at JP Morgan. Surjit Bhalla, former Executive Director, IMF. I want to come to you, Sajjid, first because I read an interesting article that you... Sajjid, I read an interesting article that you've written in the Business Standard where you've given 4 reasons why you think it's not a bad thing to have a falling rupee. Explain to us why you actually believe a falling rupee is not such a bad thing.
Thank you, Rajdeep. Good evening. Good to be here. Number one, we should not conflate a strong currency for a strong economy. In fact, what history has taught us is countries that have grown very rapidly have often done so and been able to drive export growth by keeping their currencies relatively undervalued. Why is that? Because when a currency depreciates, what happens? Your exports become more competitive. You can drive stronger export growth, number one. Your imports become more expensive, and therefore you give a better chance to your import competitors at home. So in a way, a weaker currency is helping your manufacturing sector both on the export front and on the import front, right? Number one. Number two, the current context really matters over here, right? Think of what's happening at the moment. Tariffs on India by the US are the highest in the world. The effective tariff rate is 34%. Tariffs on our ASEAN competitors are 16%, which means we're at a competitive disadvantage. If the rupee were to weaken to try and bridge some of that gap, we're actually helping offset some of that adverse tariff differential and giving our exporters the best possible chance. Number three, I think the big threat to emerging markets in the coming years is all this massive excess capacity in China. With the US putting on tariffs on China, what is China doing? It's redirecting this excess capacity to all over the world, Asia, India. India's bilateral trade deficit with China is 3% of GDP. Now, a lot of Indian businessmen will say, we won't invest in India because it's very hard to compete with cheap Chinese imports. So when you have, calibrated depreciation, again, you're making those Chinese imports a little bit more expensive and giving Indian domestic substitutes a better chance. So I think, we really should not confuse a strong currency for a strong economy and likewise a weak currency for a weak economy. The final thing I'll say, Rajdeep, is, this notion of the rupee is made a lifetime high. Every day when I get older, my age is at a lifetime high, right? Every day. And so looking at levels is sometimes very deceptive. India's inflation rate historically has been 4 to 5%. Global inflation has been 2%. To maintain our external competitiveness, a 3, 4, 5% rupee depreciation is par for the course and should not be alarming at all.
It's interesting the way you're putting it, because Surjit Bhalla, I recall 2013 when the rupee fell to what, 58.50 to the dollar, and Prime Minister Modi, then Chief Minister Gujarat, had targeted the Manmohan Singh government and said this was more evidence of a faltering economy, of a fragile economy. Now we've got Sajjid Chinoy explaining why it's not such a bad idea to have a depreciating rupee, and actually a falling rupee doesn't necessarily mean a weak economy. Is 2025 very different to 2013?
Yeah, in several ways, it's very different than 2013. And, for one, our growth rate is very high, especially compared to our competitors. Second, the inflation rate in India is very low. So therefore, what is a surprise is why is the currency weakening? The fundamentals are all in favor of a stronger rupee, not a weaker rupee. So what Sajjid and others have to explain is why in this scenario of a highest growth rate amongst all our competitors, lowest inflation rate amongst all our competitors, as Sajjid himself will tell you, that's a recipe for a strengthening rupee, not a recipe for a weakening rupee. Second or third, that India's real exchange rate is now at about 20% lower, 25% lower. He has the calculations, he'll tell you, than it should be. So therefore, our currency is very, very competitive now. Our growth rate is very high. Our inflation rate is very low. So I think we all need to ask the question, why in this scenario, and there are not too many scenarios like this for any currency in the world, where you weaken when in the face of strong economic fundamentals.
So let me take that to you, Sajjid. Explain that. We are, arguably one of the worst performing, if not the worst performing currency in Asia. So it's all very well to say there are benefits from the rupee depreciating, but the truth of the matter is, surely it should cause some concern if this becomes a free fall. It's 5% down over the year.
So 2 points, Rajiv. But let me answer Surjit's question about why the currency is under depreciating pressure. And then let's distinguish between a free fall and what's happening right now. It's undoubtedly true our macro fundamentals are much better. The inflation rate's very low, growth has picked up. But the fact is, over the last 18 months, the balance of payments has been in deficit. Surjit, this year, as you will know, the current account deficit is on track to doubling. Now, it's not a threatening level, but last year it was 0.6% of GDP. This year it's going to be 1.3% of GDP, in large part because gold prices have surged, gold imports have been high, and the current account is much wider. Capital flows, to be fair, have been slowing in the last 18 months, 2 years. We've seen FDI flow slow. We've seen equity flow slow because equities have rotated out of India into China, and bond inflows have been softer. So the fact is, the balance of payments has been in deficit. This is not some engineered depreciation by the rupee. Quite the contrary. The RBI has been intervening all year long to slow the pace of depreciation. And you have to ask yourself, at what point is it worth spending $50 billion or $100 billion to slow the pace of depreciation to its new equilibrium? When the balance of payments dynamics changes, Sujit will agree, the rupee has to find a new lower equilibrium. And I would argue, Rajdeep, in March, the rupee was at 87.50. 7 months later, if 87.50 goes to 90 rupees, that's a 2.5% decline, or a 5% decline is hardly threatening. This is not some crisis that's happening. This is the RBI making a conscious choice that in the wake of a balance of payments deficit, it's not prudent for the RBI to be selling its reserves constantly to prevent much needed adjustment, because that also has costs. When the RBI sells its reserves, it tightens liquidity and pushes up domestic interest rates. So policy making is all about trade-offs, and I think the RBI has chosen the right path, that let there be calibrated depreciation to respond to changing fundamentals.
Very interestingly put. Surjit, let me give you a final word. What lies ahead? You always like to forecast. Your political forecast can be on and off, if I may say so, but you want to give us an economic forecast for what will happen over the next 3 months?
No, I think what we need to address is, why is a rupee weakening? And I have got 2 explanations for it, and none of which I think my dear friend Sajjid would disagree with. First, FDI into India has collapsed. Net FDI into India today is about 0.09% of GDP, which is the lowest level since 1990. That is 1 year before the crisis. Second, I think the elephant in the room, which I'm sure Sajjid knows about and everybody else, is the lack, or the seeming lack, of a trade deal. You have the trade deal tomorrow or day after, right, and Sajjid and all of us will all be talking about a strengthening rupee, because that's a normal thing to happen. This is the fastest decline in the value of the rupee ever. So let's backtrack a little bit. This is not engineered by the RBI. This has shocked the RBI, and has so much so that I think the decline in the repo, much needed decline in the repo rate, may not happen because the RBI will feel,
Right.
oh my God, I'm trying to prevent the rupee from falling. So this has macro consequences for growth and for RBI. So this is not
Right.
a story very simple of current account balance and whatever. Everything is in rosy shape in India, except the fact, yeah.
Sajjid, you want to get 30 seconds? Because these are two very different points. Surjit almost seems to suggest that it's not a don't worry, be happy kind of situation. There should be some concerns, including shown by the RBI. A very quick response.
No doubt with Surjit. I agree with both of Surjit's points. The real answer should be, how do we boost FDI flows into India? And yes, how do we try and get a trade deal with the US? Those are the fundamental issues. Holding that constant in the absence of those two things, what is the best response? And the best response is, at that point, let the rupee be the shock absorber to the economy till those two fundamental issues get resolved, which I agree with Surjit on.
Let's leave it there. There's the trade deal concerns, there are FDI concerns, and these are all legitimate concerns that we have. But I appreciate two fine minds joining us and trying to demystify the falling rupee. Thank you both, Sajjid Chinoy and Surjit Bhalla, for joining us on the news today.